Hi everyone, I'm Casey. In this video I'm going to be talking about Opendoor. Right now it is going through a merger with a SPAC. I know I just made a video on Tattooed Chef, but I think this is another really great opportunity if you're looking to invest into the real estate technology space for the long term. This is a stock that I bought some of myself and I plan on holding again for the long term, just like almost all of my stocks. So we'll dive right into what it is, what I think is going to happen in the short to medium term, and then why I really like it in the long term as well. So similar to the Tattooed Chef video, if you haven't seen that, go check it out. I'll have a link in the video description and it should be at the top right of your screen right now. But similar to that, a lot of these screenshots I'm going to be putting up on the screen are from the investor presentation. So if you are interested in buying some of it yourself, of course, do your own due diligence. That's a great place of getting information, as well as other places online as well. So diving right into what is Opendoor. So as I mentioned at the beginning of the video, Opendoor is in the real estate technology sector. What they do is they basically provide quotes to people who want to buy their house. They use AI and all this different data analytics tools to basically give you a quote without having to go through a realtor or a long process to get an appraisal and a real good quote on your house. You just do it through their site. You can download their app on the phone and do it that way. And you basically get an offer from them really quickly to purchase your house. And according to them, and according to what I've been able to research online, it's a very competitive, realistic offer, which is why Opendoor, of many reasons, seems to be a great company to invest in. So we'll get into all the screenshots, but on a personal note, I just want to mention one of the main reasons why I think this is going to be such a solid opportunity and company going forward in the long term is I just really see the need for realtors and real estate agents diminishing over the years to come. In 5-10 years, I just think that technology is going to continue to disrupt the real estate industry like all other industries have been. Redfin and Zillow are starting to do that, but Opendoor is definitely a different approach, where it's basically just similar to Amazon, if you will, where if you want to buy something, you can just do it on the app and have it delivered straight to you. If you want to sell your home or buy a home, you can just do it on the app, have a quote given right to you right away, and make it a lot easier. So getting into what the investor presentation has to offer, what's really awesome about this company is they have a very experienced team. All of their head executives are from other huge companies with lots of success. And I won't go too deep into it. You can do some of your own research if you want it as well. But the main investor of Ipob, the special acquisition company that's taking them public, used to be a chief executive in Facebook for growth and grew Facebook like crazy, and is a fantastic investor, and he's the one backing this, and he strongly believes in this as well. So I won't spend too much more time on that, but basically they've got a lot of talent, a lot of experience, and it's not just somebody you haven't heard of before like Trevor Milton from Nikola. Sorry, Trevor. But point being, there's a lot of experience and reputation behind the people running this company. One of the things I wanted to mention too really quickly on how cool this company is when it comes to buying a home. So basically the kind of whole process is if you sell your home through them, they give you a quote right away, and then you can sign an agreement, and then they schedule a free inspection, and if everything's real and good to go, it goes through. And then on the buyer side of things, basically they install a lock, I'm assuming, onto the door, and basically you can schedule virtually without needing to meet anybody at all. You can just go to this house and unlock that door with the app on your phone. Tour the whole house. If you like it, you buy it like through the app, through their site, and it's just very easy and streamlined. A lot less people you have to deal with, which really cuts down the cost for Opendoor. It allows them to automate a lot of things, automate their offers, automate tours, all of the things that I just mentioned. There's a lot less people involved, which really helps reduce costs. Also, some of the cool stats that they have in their investor presentation, that they're an innovator and market leader. They've by far sold the most homes in 2019, 4.4 times larger than their next competitor, which is very impressive. We'll get into some more of their financials in a bit and their valuation, but they're making a lot of revenue which is pretty impressive. And in 2019 they had $10 billion homes sold, which is is a big deal. One of the other things I wanted to touch on is their scale. So they are definitely killing it and selling a lot of homes, but relative to their competitors like Zillow and Redfin, and just the whole real estate industry as a whole, they're still pretty small. They're in 21 markets, and as they say, they're just scratching the surface. They have a $5 billion first quarter of 2020 run rate revenue, which is very impressive, and that's only 2% of the market share. So as I was mentioning, there's a lot of room to grow. We'll get into the valuation later, but essentially right now, given the stock price, they're around like a $12 billion in enterprise value, and Opendoor is less than 1% of real estate. And you look at Carvana, which stock price has gone through the roof over the last year or so. They're at around 1% of used auto sales, and they're valued at $30 billion. And they also have Uber and Amazon up there as a comparison to basically show that there's tons and tons of value in the long term. Another thing I wanted to throw up that is a great point that they make is how COVID-19 has accelerated shifts in consumer behavior. It's not that people aren't as social as they previously were, but they kind of realize there's a lot of social aspects or interactions that aren't that necessary. Like for instance, meeting with a realtor, doing all of those things that you can just do with an app and just kind of do it on your own. You can go tour a house and kind of soak it all in on your own. You don't have to have a realtor trying to convince you or show you things that don't really matter to you and things like that. Basically, COVID-19 accelerated the shift of using real estate technology is their overall point. One of the other huge things I want to mention before we dive into the financials is how much they are growing. For a company that is through adjusted profit making a profit, however with non-GAAP they are not making a profit, growth rate is incredibly important, because if you're going to invest in a company that's not technically making a profit, they need to be growing like crazy and have a plan to make a profit, right? If you look how much their homes sold is growing at a compounded annual growth rate, 145%, which is incredible. Revenue, 159%. Okay, so the most important part is, of course, the financials and getting into the valuation as investors. That's what we really care about. It could be a fantastic company, it could be going like crazy, but if it doesn't have a plan to be profitable or the numbers make sense, then we don't really care about it as investors, right? So the part I highlighted here that is really important is, of course, the adjusted gross profit. Now we'll get into the non-GAAP financials, which is basically what they're doing, and then we'll get into the GAAP financials, which is what would be filed with the SEC, and that's what really matters. So the adjusted gross profit is positive, which is great, but again, it's adjusted. So it's been growing, which is really, really good. It went from 66 to 146 from 27 to 2018, which is like a 300% increase. And then another 100% increase from going roughly 150 to 300. 2020 projected is less than that. If we kind of dive into why, they don't give us a lot of information, but I'm guessing that has to do with like a large investment they made or something along those lines, because 2021 it jumps back up to 270, and then 2022 jumps up to 521, and the rate of acceleration keeps on going. So their adjusted EBITDA is again non-GAAP, but without taking too much time to go into the GAAP financials, we can still use this because they're still pretty accurate. They're basically not making money. EBITDA, remember, if you haven't seen my Tattooed Chef video or another video, the easiest way to think about it is profit before tax. Now, what's important here about the adjusted EBITDA is that it's negative, which is not that good, right? From 2017, it went more negative, and then 2019 went more negative, which is not necessarily a good sign given their revenue was going up. However, 2020 projected, and of course that's almost over, went back down. 2021 projected is going back up and then going down in 2022. And then 2023, they're projected of having a profit, which is great because that's not that much time, given how long some of these companies take to make a profit. You think of Tesla, you think of some of these other tech companies that have IPO, they don't make a profit for years and years. Opendoor, of course, has been around for a bit, but as an investor, waiting only a couple years is not that bad. Another thing that I want to do more research on is why the EBITDA was going down in 2018 and 2019, even though their revenues was going up. I'd like to know if that had to do with some investments they were making or what caused those expenses to be so much larger. So one of the things I plan on researching more, and I'll mention if I make a follow-up video on this, is I'm unsure of why the EBITDA went down, basically went more negative in 2018 and 2019 as their sales increased. My intuition says that it's probably because they were investing more, they were growing the business, and they had more investment related expenses due to growth, not necessarily due to operating expenses going up, because their contribution margin, which is basically sales minus expenses roughly, was going up. So I don't think it necessarily had to do with operating. And as we can see in 2023, it eventually getting profitable. My intuition says it has to do with the growth. So definitely comment down below if you've done some outside research, and no, I plan on looking into it myself, but just wanted to mention that. Now, to kind of wrap it up with valuation and closing thoughts, let's dive right into, is this company overvalued right now? How is it valued relative to Redfin and Opendoor, which are definitely the closest competitors out there right now? Let's dive right in. So at the time of this merger, it was going off of a share price of $10 at the time of making this video. Ipob, which is going to turn into Opendoor, is trading around $20. So that gives us an enterprise value of $11.05 billion, basically $11 billion, which is pretty high when you compare that to Redfin and Zillow, which are both, with their share prices kind of fluctuating around where they're at right now, like 50 or so, or the high 40s for Redfin, and in the low to mid 90s for Zillow. They're roughly, give or take a few percentages, around 9 times 2023 gross profit. And Opendoor, with the share price of $20, is around 12.4 times their 2023 gross profit. So it's definitely a little higher than its peers. It's not crazy. It's not something that would really raise a red flag, like if it was 20 or 30 times and Redfin and Zillow were around 9. It's a little higher, but I do want to mention this because as investors, we do not want to be paying for something that's overpriced and overvalued. And so even though just today, Opendoor went down, or Ipob, ticker symbol, went down 10%, I would not be surprised if it went down another 5 or 10% and kind of got closer to its peers of Redfin and Zillow. I am a long-term investor. I bought some of this around $22. I bought some more today when it tanked. And if it goes down again, I'll probably get some more as well, because I am thinking that this company is going to be a great company over the next 5 to 10 years. And like I said, if the valuation was like 20 or 30 times or something crazy, that would be a red flag, and I wouldn't want to necessarily buy right now. However, since it's only a little bit higher than Redfin and Zillow, I personally see more potential in Opendoor than Redfin and Zillow. I think they're both great companies, and if you wanted to invest in real estate technology as a whole, just diversify by getting all three. You can't go wrong. However, because I think Opendoor is the better bet out of all three, I'm not too concerned about it being a little higher valued right now, because I think with its leadership and just the way the platform is going to be run differently than Zillow and Opendoor, being tailored more towards ease and automation and things like that, and the slight overvalue right now compared to its peers not mattering that much. So kind of my closing thoughts, I basically just said a lot of them, but where do I think this stock is going to be in the next year or two? Right now it's trading around $20. It got as high as $27 during its peak, which was a lot due to hype. Definitely think it'll get there again at some point, whether that happens in the next 6 months, like short to medium term, or that happens in a year. I definitely think it'll get there. I definitely think it'll eventually get to $30 easily. You know, this is a relatively cheap stock in terms of ticker price. Maybe younger investors who are going to use Opendoor and be exposed to it, and you know, it's going to be a lot easier to justify a lower, cheaper share price that Opendoor has. So I plan on holding this for at least 3 to 5 years, maybe even longer, who knows. You know, as I mentioned earlier in the video, if the stock price continues to go down, which again, I would not be surprised if it does, if it gets a little closer to trading in Redfin and Zillow's relative to 2023 gross profit numbers, I would not be surprised. However, if that happens, I'll probably just get some more. And another thing to keep in mind is that Redfin and Zillow have gone up like crazy this year. And so there's a good chance that they could pull back some, and if that happens, Opendoor probably will too. Just, you know, kind of the whole housing, real estate, technology sector taking off, there's a good chance that it'll pull back some. So don't be worried if they kind of all do. I still think this is just a fantastic opportunity to get into now if you have a time horizon of multiple years. I'm not looking to trade this stock and sell it when the ticker symbol changes and it spikes. You know, I'm thinking this is a really good opportunity to hold long term. I could be wrong. They could easily get beaten out by Redfin or Zillow, but I'm willing to invest a small amount of money and kind of see where it goes because I think it's a cool company. So that's enough from me. Again, you know, one of the things I'll mention is I am of course not a financial advisor, so everything that I've been saying is of course my opinion, so take that with a grain of salt. Like the video if you liked it, subscribe to the channel if you're new. Comment down below any thoughts, questions, opinions. I love the dialogue with you all. Try my best to respond to every single comment I get, and any questions, I try my best to answer them as in-depth as possible. So I'm gonna be trying to make a video every day or every other day as much as I can. I know it's a lofty goal, but I'm gonna try my best. So thank you all so much for sticking with me and watching the video. I'll see you in the next one.